My name is Ray Dalio. I founded Bridgewater Associates and spent more than 50 years studying how markets, debt, and economic cycles truly work. I've advised governments and investors through every major crisis and learned why most people lose when the cycle turns. Most people think you holding cash means you're doing something wrong, that you're being too conservative, that you're missing out. This belief is dangerous, especially late in an economic cycle. When times are good, everything feels safe. Markets go up. Risk looks invisible. People confuse rising prices with intelligence, and slowly, almost without noticing, they eliminate cash entirely. Every dollar must be working. Every pause feels like a mistake. But invested does not mean safe. It only means exposed. Late cycle economies reward confidence right up until the moment they punish it. Liquidity dries up faster than people expect. Correlations rise. Assets that were diversified suddenly fall together. And the thing everyone dismissed, cash, becomes the most valuable asset in the room. The financial industry doesn't like talking about this. Cash doesn't generate fees. It doesn't require complex products. It doesn't keep you trading. So it's framed as lazy, inefficient, or outdated. You're told to stay fully invested, to ignore volatility, to trust that things will always normalize. That advice works beautifully until it doesn't. And when the cycle turns, the people without cash don't get choices. They get forced sales. They get bad timing. They become price takers instead of opportunity makers. Early in my career, I learned this lesson the hard way. In 1982, I was certain I was right. I understood the data. I believed I saw what others didn't, and I was wrong, not just wrong in theory, but wrong in timing. The market moved against me. Clients left. Cash disappeared. Being right didn't matter because I couldn't survive long enough for it to matter. I had to borrow money just to stay afloat. That experience permanently changed how I think about risk. What I learned is that markets don't reward intelligence in the short term. They reward survival. You can be right about the future and still be wiped out if you run out of liquidity before that future arrives. Cash buys time. Time lets reality catch up to your thesis. Without cash, even the best ideas die early. The biggest mistake investors make isn't losing money, it's losing optionality. When you're forced to sell, you surrender control. When you can't meet obligations, your strategy becomes irrelevant. Liquidity isn't about pessimism, it's about humility. It's admitting that timing is uncertain, that cycles can last longer than expected, and that staying in the game matters more than winning early. We are entering a part of the cycle where mistakes stop being recoverable, not dramatic mistakes, ordinary ones. Overexposure, no liquidity, assuming stability. This is late stage debt cycle territory. Roughly 70 to 80 years after the last major reset, debt levels reach a point where they can no longer be sustained through growth alone. I've studied this pattern across empires, currencies, and centuries. It always looks different on the surface and identical underneath. Debt grows faster than income. Interest payments begin to crowd out everything else. Governments face forced choices instead of preferences. Raise taxes, cut spending, inflate the currency, or restructure obligations. There are no painless options left. In the United States, interest payments are already approaching levels that rival core government functions. That's not a political issue, it's arithmetic. When servicing the past consumes the future, the system has to change. Historically, this stage ends the same way every time, either through defaults, through inflation, or through some combination of both, sometimes quietly, often violently. Asset prices swing, liquidity disappears, and confidence breaks faster than models predict. What matters most in these moments isn't optimism or intelligence, it's positioning. Those with liquidity can wait, rebalance, and buy when others are forced to sell. Those without it become part of the adjustment process themselves. Late in the cycle, cash stops being a drag and starts being protection. During deleveraging, it's not asset quality that breaks first, it's liquidity. Perfectly good assets collapse in price, not because they're worthless, but because buyers vanish. When everyone needs cash at the same time, prices stop reflecting value and start reflecting desperation. That's how strong companies, solid real estate, and long-term investments get sold at fire sale levels. Leverage turns this from a decline into a cascade. Margin calls force selling. Forced selling pushes prices lower. Lower prices trigger more margin calls. What looks orderly on the way up becomes nonlinear on the way down. The system feeds on itself. This is why diversification often fails when it's needed most. Assets that were uncorrelated in calm markets suddenly move together because the real driver isn't fundamentals, it's the need for cash. Cash buyers operate under a completely different set of rules. They don't receive margin calls. They aren't forced to sell at the bottom. They can wait for clarity instead of reacting to panic. When others are shrinking balance sheets, they're expanding opportunity. Leverage promises speed. Liquidity delivers survival. And in deleveraging environments, survival is the prerequisite for everything else. Holding cash always feels wrong at the worst possible moment, right before it matters most. When markets are rising, cash feels stupid. It's quiet. It doesn't move. It doesn't give you stories to tell. You watch others get richer on paper, and something in the human brain interprets patience as failure. That's when people abandon liquidity, not because it's logical, but because it's uncomfortable. Envy and fear of missing out do more damage to portfolios than bad analysis ever will. The pressure to always be fully invested doesn't come from math. It comes from social comparison. You don't want to be the only one sitting still while prices go up. So you override your plan to avoid looking wrong. This is how impatience destroys people near cycle peaks. They add risk when risk is already expensive. They eliminate buffers when buffers are most needed. They confuse activity with progress. The irony is that cash isn't about fear. It's about readiness. It's about being early rather than late. But psychologically, being early feels identical to being wrong until the moment everyone else is forced to admit it mattered. Most people don't lose money because they misunderstood markets. They lose it because they couldn't tolerate waiting when waiting was the correct action. Cash isn't an investment, it's an option. People evaluate cash the wrong way. They ask what it earns instead of what it allows. In stable periods, yield dominates the conversation. In unstable periods, flexibility does. And flexibility is always underpriced right before it's needed. Optionality beats yield when the future becomes uncertain. A few extra percentage points mean nothing if you're forced to sell at the wrong time or miss the best opportunities because you're fully allocated. Cash gives you the right, not the obligation, to act when conditions change. This creates an asymmetric advantage. The downside of holding cash is limited and visible. The upside during chaos is open-ended. You can buy assets others can't. You can negotiate instead of accept prices. You can wait while others rush. In every major crisis, the winners weren't the ones who predicted perfectly. They were the ones who had dry powder when everyone else was out of breath. Cash doesn't make you rich by itself. It makes sure you're still standing when wealth transfers actually happen. When crisis actually hits, the story changes fast. Prices don't drift down, they gap. Liquidity disappears. And the question is no longer what you own, but whether you can hold it. Assets go on sale not because they're bad, but because someone has to sell. Funds meet redemptions. Investors meet margin calls. Companies meet refinancing walls. The selling isn't strategic, it's forced. And forced sellers never get good prices. This is where cash flips the script. Fear paralyzes most people because fear plus leverage equals helplessness. But fear plus liquidity creates opportunity. You're not guessing, you're choosing. You can step in when others are stepping out, not because you're braver, but because you're prepared. This is how the largest fortunes are built. Not at market tops, not during optimism, but in the aftermath when quality assets are mispriced and time horizons stretch back out. Every major crash creates a transfer from the impatient to the patient, from the leveraged to the liquid. The headlines focus on destruction. The balance sheets tell a quieter story about who gained control when everyone else lost it. The most dangerous mistakes are the ones that feel sophisticated. Leverage is usually sold as intelligence, borrowing to optimize returns, using margin to be more efficient. In calm markets, it looks smart. Right before the turn, it's lethal. Leverage removes your ability to wait, and waiting is the one advantage that matters when cycles reverse. Another common error is confusing long term optimism with short term survivability. You can believe in economic growth, innovation, and progress, and still be wiped out if you're positioned incorrectly during a transition. Being right eventually doesn't help if you can't endure the path to being right. Diversification is also misunderstood. It protects against normal volatility, not liquidity crises. When cash is what the system needs, everything else gets sold. Correlations spike. Assets that behaved independently for years suddenly move together. These mistakes don't show up as errors on spreadsheets. They show up as forced decisions under pressure. And by the time people realize the difference between theory and reality, the cycle has already moved on without them. The most important rule is simple: survive first, win later. If you live through the storm, you get to buy after it. If you don't, it doesn't matter how right you were. Markets don't reward brilliance that arrives too early. They reward endurance. There's a clear hierarchy that people ignore at their own expense. Survival comes first, liquidity comes second, opportunity comes last. You don't get access to the upside without earning the right to stay in the game. This is why solvency beats cleverness every time. Clever strategies break under stress. Simple ones endure. Cash doesn't need to be smart, it just needs to be there. In periods like 2026 and 2027, the winners won't be the ones who squeezed the last drop of return out of a mature cycle. They'll be the ones who accepted lower returns temporarily in exchange for control. Because control over time, over decisions, over risk is what turns chaos into advantage. Cash only matters in relation to your life, not your ego. The question isn't how much you have compared to others, it's how long you can last without being forced to act. Measured this way, liquidity becomes clear. Months of expenses covered, then years. Each additional layer reduces pressure and increases clarity. Once your basic survival is secured, your psychology changes. You stop making decisions to avoid pain and start making them to create advantage. That shift is hard to overstate. When you know you don't need to sell, don't need to borrow, don't need to rush, your behavior improves automatically. You see risk more accurately. You wait for better prices. You let opportunities come to you instead of chasing them. Cash gives you time. And time is the hidden multiplier in every cycle. Time lets bad assets fail and good assets reveal themselves. Time lets panic exhaust itself. Time allows compounding to restart from a lower base with higher future returns. In chaotic periods, money doesn't compound through activity, it compounds through patience. The smartest move right now isn't chasing the last bit of upside, it's reducing fragility. That means lowering leverage, simplifying portfolios, stress testing your life, not just your investments, asking one uncomfortable question: what breaks if income drops or markets freeze? And fixing that first. You don't need a perfect forecast. You need a system that works even when you're wrong. Predictions fail, systems endure. Cash buffers, diversified assets that behave differently under stress, and rules you don't override when emotions spike. That's what carries you through transitions. The goal is simple: be positioned to buy when others are forced to sell. Not because you're braver, not because you're smarter, but because you prepared early enough to have a choice. In every cycle, there are victims and there are buyers. The difference is decided long before the headlines change. Cash is quiet power. It doesn't announce itself. It doesn't impress anyone. And right before it becomes essential, it looks completely useless. That's the pattern. At the top of cycles, visibility is rewarded and patience is mocked. The people who look the smartest are usually the most exposed, and the ones holding cash feel late until they're suddenly early. There's a big difference between looking rich and staying free. Looking rich means being fully invested, fully committed, fully dependent on everything going right. Staying free means you can absorb shocks, wait out storms, and act when others can't. Cycles don't end politely. They end by transferring control from the impatient to the prepared. If you survive the cycle, you earn the right to capitalize on it. That's the real lesson. Protect liquidity, respect cycles. Stay in the game long enough for opportunity to find you.